We will now look at the economic policies which shape up the or influence the economic environment as such. So, the first policy that actually shapes up the economy, though there are several economic policies which can have a great impact on the business. However, some of the most important economic policies include industrial policy, trade policy, foreign exchange policy, monetary policy, fiscal policy, foreign investment, and technology policy. Again, some types or characters categories of business are favorably affected by government policy and some adversely affected, while it is neutral in respect of others. Similarly, an industry that falls within the priority sector in terms of government policy may get a number of incentives and other positive support from the government, whereas those industries which are regarded as inessential may have odds against them. So, industrial policy, which is the first one, and this is the industrial policy of 1991, which is known as also the new industrial policy. It was announced on 24th July 1991. And the main aim of this policy was to correct the distortion and weakness of industrial structure of the country. And this, why? Because it had been developed across the decades, and not just one decade, it's 4 decades. Second, the objective was to raise the industrial efficiency to international level, as well as to accelerate the industrial growth. So, what are the salient features? Again, let before we move into the salient features, let us understand why this industrial policy. What is the scope of it? The industrial policy can define the scope and role of different sectors like the private, public, joint, and cooperative, or large, medium, small, and tiny. It may influence the location of industrial undertakings, choice of technology, scale of operation, product mix, and many others. Again, if you really look at India, until liberalization was assured in 1991, the scope of the private sector, per se, particularly the large enterprises, was very limited. The development of 17 of the most important industries was only reserved for the state, that is the government. Again, in the development of another 12 major industries, the state was to play a dominant role. In the remaining industries, cooperative enterprises, joint sector enterprises, and small scale units were to get a preferential treatment over large entrepreneurs in private sector. Further, the production of large number of items was reserved for the exclusive manufacture of small scale sector. Even in respect of industries which were open to private sector entry and growth were regulated by licensing. Also, in the case of certain categories of large firms, the MRTP Act. The government policy thus limited the scope of private businesses. So, the new industrial policy, as discussed, which was assured in July 1991, widely opened all but a few industries for private sector, dramatically changing the business environment. In the pre-liberalization era, the government policy was a severe constraint on the portfolio and growth strategies of the companies. So, what are its salient features? The new industrial policy. One, the number of industries reserved for public sector was reduced from 17 to just 8. That is, arms and ammunition, atomic energy, coal, mineral oil, mining of iron ore, manganese ore, gold, silver, mining of copper, lead, zinc, atomic minerals, and railways. Currently, only two categories from these mentioned, that is the atomic energy and railways, are reserved for the public sector. And if you really look at the railways, also many of its dimensions are now being privatized as such. Catering has been privatized, cleanliness has been privatized, and many such things. The industrial licensing policy, that is the list of 18 industries which was pruned, was further reduced to six, that is drugs and pharmaceuticals and hazardous chemicals. Industries reserved for small scale sector continue to be reserved so. Foreign investment and capital. This was the first in terms of foreign investment and capital. This was the first industrial policy in which foreign companies were allowed to have a majority stake in India, that is, in Indian companies. In 47 high priority industries, up to 51% FDI was allowed. For export trading houses, FDI up to 74% was allowed. Today, if you really see, there are numerous sectors in the economy where government allows 100%, for example, retail. The government also established a special empowered board called the Foreign Investment Promotion Board to negotiate with international firms and approve FDI in the selected area. In terms of foreign technology agreements, automatic permission was given for foreign technology agreements in high priority industries to a lump sum payment of 1 crore, 5% royalty for domestic sales, and 8% for exports, subject to a total payment of 8% of sales over 10-year period from the date of agreement or 7 years from the commencement of production. A promise was made to review the portfolio of public sector investments with a view to focus public sector on the strategic high-tech essential infrastructure indicated in the divestment of the public sector. There were amendments which were carried out in the MRTP Act to remove the threshold limit of the assets. Again, this eliminated the requirement of prior approval of central government for establishment of new undertakings, expansion of undertakings, merger, amalgamation, and takeover. The definition of tiny unit was changed as a unit having an investment limit of less than 5 lakhs. Another policy or act which influences the business is the FEMA, Foreign Exchange Management Act. It is an act that consolidated and amended laws governing foreign exchange. Primary objective of FEMA was to facilitate external trade payments, promote orderly development, maintenance of foreign exchange. FEMA was replaced actually FERA. Again, if you really see, FEMA regarded all forest related offences as civil offences, whereas FERA regarded them as criminal offences. So FEMA did not apply to Indian citizens who resided outside India, Again, it authorized central government to impose restrictions on and supervise three things, mainly payments made to any person outside India or receipts from them, forex and foreign security deeds. Specified the areas around acquisition, holding of forex that required specific permission from the Reserve Bank of India or the government. FEMA put foreign exchange transactions basically into two categories. One, capital account and current account. Capital account transactions altered the assets and liabilities outside India and inside India. But of a person resident outside India, thus any transaction that changed overseas assets and liabilities for an Indian resident in a foreign country or vice versa was classified as a capital account transaction. Any other transaction which fell into the category of the current account category. So, again, how does it empower authorities and citizens? RBI has the overall controlling authority. Again, authorized persons could draw or sell forex. FEMA allowed Indian residents to carry transactions in forex, foreign security, and to own immovable property abroad. FEMA regulations covered foreign forex transactions and remittances. There were many subsequent regulations and notifications which were issued in regards to authentication of documents, current account transactions, education procedures, etc. The other policy which influences the business environment is the monetary policy. Now, what does the monetary policy mean? Monetary policy refers to the policy of the central bank, that is RBI, in matters of interest rates, money supply, availability of credit. Again, it is through monetary policy that RBI controls inflation in a country. It uses various monetary instruments like repo rate, reverse repo rate, SLR, CRR to achieve this purpose. Now, monetary policy, if you really see, if one were to actually, ask you to briefly define it, it refers to the use of monetary instruments under the control of central bank to regulate magnitudes such as interest rates, money supply, availability of credit, in view of achieving the ultimate objective of economic policy. So the primary objective is to maintain the price stability. And to maintain price stability, inflation needs to be controlled. So government of India always, it sets a target of inflation every 5 years, and RBI has to do so in consultation with the government. So the monetary policy instruments include repo rate, that is the fixed interest rate at which RBI provides overnight liquidity to banks. Reverse repo rate, fixed interest rate at which Reserve Bank absorbs liquidity on overnight basis from banks against the collateral of eligible government securities under LAF. What is LAF? Liquidity Adjustment Facility. Liquidity Adjustment Facility consists of overnight as well as term repo options. Progressively, our Reserve Bank has increased the proportion of liquidity injected under the fine-tuning variable rate repo options of range of tenors. The aim of term repo is to benchmark for pricing of loans and deposits and hence improve the transmission of monetary policy. The Reserve Bank also conducts variable interest rates, reverse repo auctions as necessitated under the market conditions. Marginal standing facility, again another tool of the monetary policy, a facility under which scheduled commercial banks can borrow an additional amount of overnight money from Reserve Bank by dipping into their SLR, that is the statutory liquidity ratio portfolio, up to a limit of penal rate of interest. This provides a safety valve against the unanticipated liquidity shocks to the banking system. Instruments include margin standing facility, a facility under which scheduled commercial banks can borrow an additional amount of overnight money. Corridor, the MSF rate and the reverse repo rate determine the corridor for daily movement in weighted average call money rate. Bank rate, again, what is bank rate? It is the rate at which Reserve Bank is ready to buy or rediscount bills of exchange or any other commercial paper. Cash reserve ratio, the average daily balance that a bank is required to maintain with the Reserve Bank. SLR, share of NDTL that a bank is required to maintain in safe or liquid assets. Open market operations, these include both outright purchases and sale of government securities. Market Stabilization Scheme, instrument for monetary management, introduced in 2004. Surplus liquidity of a more enduring nature arising from large capital inflows is absorbed through sale of short-dated government securities and treasury bills. Fiscal policy. Fiscal policy refers to the use of government spending and tax policies to influence economic conditions, that is, demand for goods, services, employment, inflation, economic growth. It refers to the use of government spending, tax policies, largely based on ideas of Keynes as such. During a recession, government may employ expansionary fiscal policy by lowering tax rates. Again, in the face of mounting inflation and other expansionary symptoms, the government may pursue contradictory fiscal policy. So, what are the objectives of fiscal policy? Economic growth. Obviously, fiscal policy has to maintain economic growth rates so that certain economic goals can be attained. Price stability controls the price level of the country. Full employment. It aims to achieve full employment, not just half, near full employment as a tool for recovery of low economic activity. What is the importance of fiscal policy in India? A country like India, fiscal policy plays a very important role. It helps in elevating capital formation in both public and private sectors. It helps to mobilize considerable amount of resources, helps to provide stimulus in elevating savings rate, gives adequate incentives to private sector to expand its activities, and aims to minimize the imbalance in dispersal of income and wealth. Some of the articles for review that you can go through, the links will be shared on the LMS, and you can actually review them for a deeper understanding of the concept.